Yields on the 10-year falling sharply over the past 3 months. Joining us now to discuss other opportunities for yielding returns, Tony Despirito, head of U.S. Fundamental Active Equity at BlackRock and portfolio manager of the BlackRock Equity Dividend Fund. Tony, great to see you. Thanks for joining us.
Great to be here.
Let's start with Mike's charts just there. I mean, what do you take of that analysis of where the S&P 500's valuation is at the moment?
Yeah, so I think this has been a rising market, but it's been climbing a wall of worry. I do think stocks are the best game in town. Look at the 10-year Treasury. A year ago, that was at 3%. Today, it's at 1.6%. We're in a market now where you can actually get more income from stocks than bonds, and that's historically very unique.
Which groups in particular are you looking at for your investors?
So in our fund, the fund I manage, the Equity Dividend Fund, we really emphasize growth of income as opposed to current income. I think there's some value traps amongst the highest yielding stocks, the bond proxies, if you will.
Like what?
Utilities, REITs. REITs are trading at all-time high multiples. So I think there's some risk there. I think you're much better off focusing on stocks that can grow that income over time.
What stands out for you?
An example of an underappreciated stable business is insurance brokers. We need insurance. Companies need insurance regardless of the economy. So even in a recession, companies buy insurance, and it's a good business. It's a capital-light business, unlike insurance itself, which requires a heavy balance sheet.
Does that change if one of these Medicare for All plans goes into place?
Okay, so let's talk about HMOs, right? I was talking about corporate insurance, but HMOs, I think the risk of Medicare for All is wildly overdone. You know, if you look at the polls in death, people like their insurance, they just want to pay less for it, but they don't want to give up their insurance coverage. In fact, if you look at the Medicare business, it's actually, there are two pieces. When you sign up for Medicare, you can get coverage from the government in the traditional fee-for-service program or a private HMO. Increasingly, seniors are opting for that private HMO. Actually, 37% of Medicare recipients are actually in that private part of Medicare. Medicare Advantage is called.
Mark, where do you stand in terms of high-yielding stocks? What are your core picks?
Yeah, so we like dividend growth stocks in general. We manage a dividend growth strategy for our pre-retiree and retiree clients because not only over the last 20 years, the dividend aristocrats have outperformed the S&P 500 by about 4% a year, but they've also done so with significantly less volatility. So when you look at some of our top dividend picks, Broadcom, roughly a 3.5% yield, Abbott Labs. So there's companies out there that just as we talked about with regards to growth is just as important as the dividends. Not necessarily the level of the dividend, but the fact that they can continue to increase that dividend year after year.
Tony, of course, I get the argument that dividend-yielding stocks look attractive relative to where bond yields are. As to the question of whether they're still attractive in absolute sense, do you get worried that we'll see equities broadly sell off because we might be late cycle or we might have a recession around the corner?
So I do think we're towards the later innings of a cycle, but I don't think we're at the end of the cycle. I think this time in the cycle, it's really important that you like what you own and that you be prudent in the way you're investing. But look at the market multiple. It's not out of bounds. It's right in that range, as we were pointing out earlier. So I'm not really worried about valuations.
What about the banks? They're kind of perfectly in the middle of the crosshairs of that question of they look cheap, they've got a dividend, but they might be exposed to where we are in the cycle.
Sure. I like to think about things in stable bucket and economically sensitive bucket. In the economically sensitive bucket, I think banks are one of the best deals out there. They're way safer and sounder than they were historically because they have more capital. That capital provides a cushion in a downturn, yet they're trading at extremely low multiples, 10 times, 11 times current earnings. I think that's the best value in that cyclical bucket.